Hello class, this is a video lecture of chapter 19 of the business mathematics text, and the chapter is titled Insurance. Now before I move forward in the video presentation, it's important for you all to know that I'm not an insurance broker. I'm not licensed to sell insurance, so there are other insurance professionals who are more qualified than I am to guide you with insurance related questions. If you do have any questions, you can always feel free to let me know and I'll be more than happy to help you out. But the purpose of this presentation here is mainly to just give you like a broad overview of the insurance markets and to provide you with some basic terminology to have the fundamentals you need to move forward a little deeper into the topic. All right. So, section 19-1, learning outcomes, estimate life insurance premiums using a rate table and apply the extended term non-forfeiture options to a canceled whole life policy. Some key terms: insurance is a form of protection against unexpected financial loss, and a comprehensive policy is an insurance policy that protects the insured against several risks. The insured, or sometimes referred to as the policyholder, is the individual, the organization, or the business that carries the insurance or the financial protection against loss. The insurer, or the underwriter, is the insurance company that insures for a specific loss according to contract provisions. And the policy is the contract between the insurer and the insured, so between you and the insurance company. The premium is the amount paid by the insured for the protection provided by the policy. Face value is the maximum amount of insurance provided by the policy. A beneficiary is an individual or a business or organization who the proceeds of the policy are payable to. Term insurance is insurance purchased for a certain period of time. At the end of the time period, the policy has no cash value and the insurance ends. Whole life or ordinary insurance is the insured pays premiums for his or her entire life. At death of the insured, the beneficiary receives the face value of the policy, ideally. If the policy is canceled, the insured is paid the cash value of the policy. Universal life insurance policy provides permanent insurance coverage with flexibility in premium payment and death benefit options. Life insurance pays a specified amount to the beneficiary and provides financial assistance to the surviving dependents of the insured person. A company may offer life insurance as a fringe benefit to its employees. Several types of policies exist, and some of them even function as savings policies. How to estimate life insurance premiums using a rate table. The first step is to, of course, go to your table on Chapter 19, Table 19-1. According to type of policy, age, sex, rate, and class. We're not going to go extremely into this. This is just kind of like for you to see the difference between the different types of insurance: 10-year level term, 20-year whole life, universal life. And then mind the key down here. PRAFI means preferred, NT means non-tobacco, so that means you're a smoker or a non-smoker, and that matters for the insurance companies because it's been proven that tobacco usage attributes to a shorter life, diseases, and whatnot. The second step is to divide the policy face value by 1,000. So then here you have the policy face values. Went ahead. And multiply the quotient by the rate from step 1. So the estimated annual premium equals face value over $1,000 times the rate. So here's an example. Estimate the annual premium for a life insurance policy with a preferred rate class and a face value of $100,000 for a 30-year-old male. And then it's asking you to check it for these four: a 10-level term, a 20-level term, whole life, and universal life policy. Use table 19-1 for premium calculations. Estimated annual premium is 100,000 divided by 1,000, like as illustrated in the formula in the previous slide, times the rate equals 100 times the rate. So you have 100 times 87 cents, that's $87. Here you have 100 times $1.12, that equals 112. For the whole life, you have 100 times $10.86, that's 1086. And then here you have 100 times $7.41 equals 741. Table 19-2 shows the premium rates for periods less than 1 year, semi-annually, quarterly, or monthly. So table 19-2, premium rates for periods less than 1 year. Okay, so you have percent of annual premium, semi-annual it's 51%, quarterly is 26%, and then monthly you have 8.75%. As an example, estimate the premium for a $250,000 whole life policy on a 30-year-old female using a non-tobacco rate for semi-annual, quarterly, and monthly rates. And then, of course, refer to Table 19-1 and 19-2 to assist with the calculations. The annual premium is going to be, again, face value divided by 1,000 times the rate. So in this case, it's going to be 250,000, which is given, right? Divided by 1,000, which is provided by the formula, and then times the rate. And the rate, of course, you're going to get it from the tables. It's not from up here. So then here we have $3,370, right? So now we know we're going to do, actually it was my fault. This is not 51 cents. Take note of that if you're watching this video lecture. And I'll make the edits also. This is 51%. So 3,370 times 0.51 equals 1,718.70 cents. Again, we have 3,370 provided by the solution that we figured out down here, times 0.26 for 26% equals 876.20 cents. For the monthly rate, you have 3,370 times 0.0875 for 8.75%, and we get $294.88. Some key terms, fixed time payment. And just to go back for a sec, that would mean that in this slide here, in this slide it is dollars. I'll make some edits to that. Sometimes when the publisher puts out slides, it's kind of funny how they're not consistent with each slide. Key term, another key term, fixed time payment insurance policy gives a specific face value for the insured's entire life. Payments are made only for a fixed period of time, at the end of which the insured has paid up insurance. Fixed time endowment insurance policy is a combination of insurance and savings plan that is paid for a fixed period of time. Variable life is a policy that builds up a cash reserve so you can invest in various choices offered by the insurance company. And growth in the reserve is based on investment returns. Applying extended term non-forfeiture option to a canceled whole life policy. Most life insurance policies except term life build up cash value. If a policyholder cancels, in other words, if you cancel, or allows a policy to lapse, the insured normally has three choices called non-forfeiture options. You can do a cash value or surrender option. You can do the paid up insurance option or extend term insurance. Step 1, identify the cash value of the canceled policy. Step 2, estimate the annual premium for the term policy of the same value. And then you want to use the 10 or 20-year term rates in the table in Chapter 19. Third step, determine the number of years of paid up insurance. So here, years of paid up term equals cash value of surrender policy over annual premium of term policy. So as an example, you have Eleanor, who's a smoker, started a $100,000 whole life policy when she was 30. At her age 50, so now we know there's 20 years difference here. The policy has a cash value of $20,200, and she wants to convert it to an extended term for the same face value. Using the 20-year level term rates, estimate how long her extended term insurance will last. So we know the estimated annual premium amount is $8.02 per $1,000. So then we have the face value of it, of the policy, $100,000 policy divided by 1,000, which is given from the formula. That gives us 100 units. $8.02 times 100 units equals 802 annual term rate. So the years of paid up term equals $20,200 divided over the annual term rate, which is $802. That equals 25.187 years. So her life insurance will be extended for 25 years. So until she's 75. Learning outcomes for section 19-2. Estimate renter's insurance premiums using a rate table. Homeowners insurance premiums using a rate table. Find the compensation with a coinsurance clause. Property insurance. Businesses and homeowners need property insurance to protect them from financial loss and some things that they can experience are fire, storms, burglary, vandalism, and other threats. Rates for property insurance coverage are dependent on the likelihood of loss, and they vary by state, region, or community, etc. So like in Florida, for example, even though we're prone to floods, not every community is zoned for flood. And this is something that's extremely important for us to know, especially in our time, because since we are at high risk for hurricanes, for example, like you want to make sure that the insurance policy will cover all of the what ifs. And unfortunately, during some of the hurricanes that have taken place, whenever policyholders go to go to make claims, they come to find out that they didn't have like a flood policy, or that their policy covered for structural damage but not for water damage or something like that. So you have to imagine, and the way that I think about insurance is like a giant, it's like a giant pool, right? So then this is my pool here. So then every month there's thousands and millions of people putting money into this pool, right? And the insurance companies, they have their operational costs, they have their employees that they have to pay, they have structural costs also for their buildings and advertising and whatnot. And you have to figure that they also have to set aside a separate fund to pay out insurance should a natural disaster occur or something to that effect. But keep like just having this simple idea in mind, you come to realize that the whole pot is not available for all policyholders. It's only maybe like a fraction, right? So then they play the risk game, and the risk game is that they calculate what the likelihood is of you suffering one of these losses, and then they make sure that what they collect from all of the policyholders will yield them a high profit. So you want to keep this in mind also, and just be very careful when you're purchasing insurance. The cheapest insurance policy is not always the best way to go when it comes to that. I know that not necessarily when it comes to like property insurance, but when it came to automobile insurance and when it came to health insurance, one change that I could have made, one decision that I could have made would have resulted in a significant bill that I had to pay. And I'm glad that, that I had the insurance that I had, because I'm one of those types of people that, I mean, if I feel like I don't need it, I won't get it. And for me, insurance has always been like a hazy expense for me, because I'm always like, well, I can just be very careful, but there are limits to that carefulness. So you want to make sure you read the fine print, and when you're shopping around for insurance, you ask all the questions you have to ask. You write down the representative's name who you spoke with, and then you get everything in writing, so that if it comes time to make a claim, you're covered. Okay. Increasingly, insurance companies are using credit scores to help determine rates. Even occasional late payments past 30 days can increase your premiums, so be sure to pay your bills. So um, they're using credit scores, and this is actually um, a very recent article, a very recent publication, And I mean, if you ask me, I can lecture for hours on how I think using credit scores can be discriminatory in determining rates, and it can be kind of like selective. Insurance companies can be selective with who they provide insurance to. It's kind of like a way for them to avoid insuring high risk people who they know are going to get into accidents or suffer burglaries and whatnot. But I mean, that's a whole different class, a whole different course reference number, and a whole different grade level. So I won't touch that. But if you want to have the conversation, I'm open to it. So anyways, step one, locate the base annual premium in table 19-3 according to maximum policy coverage limit, liability limit, deductible, and credit score rating. Step two, add the cost for any option selected. And the third step is compute the annual cost for extended coverage endorsement. So the cost equals the coverage desired divided by 100 times the rate for the endorsement. And the fourth step is to add the premiums from step 1 to 3. So here's an example. Kristen has excellent credit score, decides to buy renter's insurance with identity and theft fraud protection and an additional $2,000 computer equipment coverage. Find the annual premium for a $20,000 policy with a minimum liability protection using a $1,000 deductible. So here we pick out the important parts of the question. We know that the base annual premium is $126 and the cost for identity theft and fraud protection is $20. Hypothetically speaking, I anticipate that this amount is going to continue to go up, and there's other ways aside from identity theft protection that I think you can also use to protect yourself. One of these ways, as I've done some research on this recently, is to never ever ever log into your to anything that requires your bank account password, your bank account number, or your social security number or address info in a Wi-Fi hotspot. Because if you are in a Wi-Fi hotspot, then all the keys that you enter, from your laptop sitting in a Starbucks or whatever can be captured. So if you're gonna go to Starbucks, just use your laptop to like read the news or to like log into D2L to do your homework and email, professors or people or whatnot, but don't do anything sensitive with it because there could be a hacker sitting nearby capturing the information that you key in. So that's one way that you can protect. And another one is also that banks are what's called FDIC insured. So they insure the depositors up to a certain amount, and I think the amount is either maybe $150,000 or $250,000. I can't recall right now, but they also protect your deposits. So one way to hedge against that, if you have, for example, like if you have $1 million, for example, would be to have multiple bank accounts at different banks. That's one way to protect against that. But I don't know if any of us have $1 million in the bank account. Additional computer coverage, going back to the example, went on a tangent there. Additional computer coverage equals $2,000 over $100 times 95 cents, and that equals 19. So the total annual premium is going to be $126 plus 20 plus 19, which equals 165. Estimating homeowners insurance premiums using a rate table. The first step is to went ahead there. The first step is to locate the base annual premium in table 19-4 from your text according to construction type, zone, deductible, and credit score rating. Subset of that is to add the cost for any option selected. So base annual premium equals dwelling coverage over $100 times the rate from the table. The second step is to add the cost for any option selected. And the third step is to compute the cost for extended coverage endorsement. So the cost equals the coverage desired divided over 100 times the rate for the endorsements. And the fourth step is to add the premiums from step 1 to 3. So here's an example. Eric and Angela needed to insure their masonry home, located in zone 1 for $150,000 using a $1,000 deductible. They decide to add identity theft fraud protection and some pump backup protection with an additional $3,000 of protection for jewelry, watches, and furs. Find the annual premium for their policy if they make occasional payments past 30 days. Base annual premium equals dwelling coverage over 100 times the rate. So 100 and that equals $150,000, which is given from the problem, over 100 times 36 cents equals $540. Cost for the identity theft fire protection is $20, and the cost for the sewer backup is $75. Cost for additional coverage for jewelry, watches, and furs, right? So here we have the cost, which equals the coverage desired divided by 100 times the rate for the endorsement. So then we have, maybe this will make it easier to see, 3,000 over 100 times 85 cents equals $25.50. So the total annual premium is 540 plus 20 plus 75 plus 25.50 equals $660.50. Find the compensation with a coinsurance clause. A coinsurance clause states that property must be insured for at least 80% of the replacement cost or full compensation for a loss. Individuals take out this kind of policy to save money on premium. So, for instance, a fire rarely destroys a whole building or all of its contents. Although depending on where you live, it might totally damage a whole building, in my opinion. And so can a hurricane and a tornado. Find the compensation with a coinsurance clause. Step 1, find the face value required by the 80% coinsurance clause for the full compensation. So here we have 0.8, which is represented by, for the 0.80, times the replacement value of the property. Step 2, find the compensation for the loss if the insurance is less than 80% of the replacement value. So you have the loss times the face value of the policy divided over 80% of the replacement value. So here's an example. Cassandra owns a home with a replacement value of 200 grand. It has an 80% coinsurance clause and a face value of 130,000. There's a fire and the building damage is figured to be 50,000. Does Cassandra carry as much insurance as her coinsurance clause required for full protection? What will the insurance company pay as a compensation? So let's figure it out. Here we have 0.8 for the 80% times $200,000 equals 160,000. Her policy is only 130, so she does not get full compensation for the loss, unfortunately. So this goes back to what I was telling you before of reading the fine print and asking all the questions and all of the what ifs. If you're paying for insurance, you're also paying for a service and you're also paying the salaries of the insurance people. So don't feel bad about keeping them on the phone for an hour if you have to, and making sure that you get all of the what ifs. What if a hurricane happens? What if we get flooded? What if someone comes in and breaks into my home? What if this happens? What if there's a fire? Because that way you'll have a little bit more of an understanding of, number one, the responsibleness of that insurance company, and also make sure if your plan covers you for what you want. Compensation equals loss times face value of the policy over 80% of the replacement value, and that equals $50,000, which is the loss incurred, times 130,000, which is the face value of the policy, and 80% of the replacement value, which is 160,000, and that equals $40,625. Learning outcomes for section 19-3. Find auto insurance premiums using the rate tables. A major expense item for individuals in business due to high risk of personal injury or death and damaged property. And I guess this tried to say an auto insurance policy. It covers risks such as liability for personal injury and property damage, damage to or loss of the insured vehicle or its occupants due to collision, theft, fire, floods, or storms. Liability insurance, protection for the owner of a vehicle if an accident causes personal injury or property damage to others and is the fault of the driver of the insured vehicle. And then this is where it enters into a gray area, because fault is something that's determined through facts and also through a little bit of subjectivity. And it depends. If someone hits you from behind when you're going down I-95, they can allege that you hit the brakes too soon and then you are at fault. Or if you hit someone crossing the street and it was their fault. I feel like maybe um, the pedestrians will get a little bit more respect because you were the one driving the car, even though they threw themselves onto the car. That happened to my mother, by the way. But anyways, fault is what's determined um, after the accident takes place, and it has to do with a variety of factors. Comprehensive insurance, the protection for the owner of a vehicle for damage typically caused by a non-accident incident, such as fire, water, theft, vandalism, or other risks. And something like this happened to me when I was in New York. I had my car parked, and in New York, you parallel park, and eh, um, someone who had a car parked in their lot was backing up, and I guess they didn't hit the brakes or whatnot, but they ended up smashing in the door of my car. So there went my vacation. But anyways, the person's insurance ended up paying for the door replacement, which is actually much more than than I had thought it was gonna be. It ended up being like 2 grand that was billed to their insurance company, but I didn't even have to provide my insurance information at all since they were covered. Now, if the person was not covered, they hit my door, and then they would have taken off. I'm stuck, and I would have to go to my insurance since the person hit my car and left. So you might want to take a look at the numbers and see like the percentage of people who are insured with vehicle insurance, and then just take into account like what's gonna happen if someone hits you and they're insured, if someone hits you and they're not insured, if someone hits you and they run away. I mean, all of these things could potentially happen, and I'm pretty sure some it has happened to some of you. Or maybe you hit like a stop sign or something like that. You want to make sure that your insurance will cover it. Uninsured or underinsured motorist coverage, protection for the owner of a vehicle when damages are incurred in an accident that is not the owner's fault, but the other driver has no or insufficient insurance, and that's uninsured or underinsured motorist coverage. Medical expenses provides for payment of 100% of any medical bills up to the coverage limit arising from collision, covering the driver and each passenger in the insured's vehicle. And territory is the primary location where the vehicle is driven. Liability limits is the maximum amount of insurance a company will pay for a single accident based on coverage selected by the insured. So, for example, 50-150 means that a max of 50,000 for bodily injury per person, 100,000 max for all bodily injuries combined, and 50,000 is the maximum property damage total. Bodily injury is personal injury sustained in an accident, and property damage is damage to the property of others in an accident. Factors affecting the cost of automobile insurance: location of the vehicle, so city, town, rural area. If you and this may or may not seem discriminatory to you, but if you live in a zip code where there's more car thefts, then your insurance is going to be a little bit more expensive because the car insurance companies are gonna assume that you are at a high risk for getting your car stolen. So a lot of people, I mean, I don't know the parameters of the legality of this because, as I said in the beginning, I'm not an insurance person and I'm not licensed to sell insurance, and I have no interest in selling insurance. But some people say that they live in a different address in order to pay less money, or use a relative address. And I'm not encouraging that, just saying it because it's true. Total distance traveled per year. So like, sometimes they'll be like, oh, where do you live and where do you drive? Where do you work? Oh, I drive to school and back, and that's all I do, and then that's it. But then that has a caveat to it too, because if you get into a crash outside of that, then then how is the insurance company going to respond to that? Distance travel to work each day, types of use: personal, commuting, and business. Academic record of the driver. For students, you can get a discount. I know Geico gives you a discount if you show your enrollment verification form. And you can simply show your enrollment verification form. You can get it from the registrar's office or financial aid, or just going straight to the clearinghouse, the Department of Education's clearinghouse, and getting that certificate provided to the insurance company, and you get a discount. So it's pretty cool. Driving record and training of the insured drivers. The age, sex, and marital status of the insured driver also matters. The type and age of vehicle, the amount of coverage desired, and the credit rating age category of the policyholder. So here's table 19-5, annual automobile liability insurance premiums. And then we have liability limits. Territory 1, Territory 2, this is just comparing two generic territories. Good means good credit. OCC is occasional payments, and then bad is when you have judgment, bankruptcy, collections, and whatnot. So this is just to show you like the liability limits, and it'll normally say it on your insurance card what kind of liability limits it has: 50, 150, 100, 300, 100, 250, 500, 250, 500, 1,000, 500. Here's table 19-6, which is annual auto insurance premium rate for comprehensive and collision. And then here we have a divided comprehensive and then collision, and this is all for territory 1. And then here's the class of the vehicle age, and then your credit, 0 deductible, 250 deductible, and here we have collisions, 500 deductible, 1,000 deductible. But this is just to show you that it changes, right? This territory 2, comprehensive and collision, 0, 250, 500, and 1,000 deductible. You can take a look at that at your leisure. A deductible, we've said deductible a whole lot, and we hear it in all type of insurance cases, but a deductible is an amount an insured pays for damages to the insured vehicle before the insurance company pays for damages in excess of the deductible amount. Book value of the particular year, make and model of a vehicle published for car dealers and insurance companies. So then this is like the Kelly Blue Book, for example. It'll tell you the value of the book. And that matters to insurance companies because they want to know how much to reimburse if you have a total loss. If the damages resulting from an accident exceed the book value, the insurance company will only pay the book value and the automobile is said to be totaled. So if you bought a car and, for example, and the car was $14,000 and now the car is only worth $3,000, if you total your car, you'll only get the book value of the car. Okay? So then that's important to take note of and important questions to ask when you're dealing with insurance companies. Find automobile insurance premiums using rate tables. Step 1, locate the bodily injury and property damage premium according to territory, credit rating, and per person per accident. Bodily injury and property damage coverage. Second step is to find comprehensive premium by model, class, vehicle age, territory, credit rating, and deductible. And the third step is to find collision premium according to model, class, vehicle age, territory, credit rating, and deductible. Fourth step, add the premiums from step 1 to 3 to find the base annual premium. The fifth step, multiply any acceptable discounts by base premium and subtract. And the sixth step, add any ticket or accident surcharges. So the total annual premium, here we go, good formula to keep in mind as you do your homework. Bodily injury, property damage premium plus comprehensive premium plus collision premium minus discounts plus surcharges. And that'll give you the total annual premium. As an example, use tables 19.5 and 19.6 to find the annual premium for an automobile liability insurance policy in which the insured lives in Territory 1, has good credit, and wishes to have 50/150 coverage. The automobile is a 3-year-old model class 2 vehicle with 250 comprehensive and 500 collision deductible. So BIPD premium is $385. The comprehensive is bodily injury, right? Comprehensive premium is $301. Collision premium is $417. So the base annual premium is $1,103. Accident free, 5%. So then that's 1,103 times 5%, which as a decimal is 0.05, and that equals $55.15. And then that's what we're going to subtract from all this. So we have 385 from here, 301 from here, plus 417 minus the discount from here equals $1,047.85 as the total annual premium. And this concludes the video lecture for chapter 19 of the business math text. If you have any questions, comments, or concerns, or need any additional guidance on the homework, or have any questions in general about this chapter, please feel free to contact me. And as always, to promote class engagement, if you can send me an email with the telling me what this is, what the image is on my screen, I will give you extra participation points for watching the video lecture. Thanks and have a great day.